Hi, everyone, and welcome to today's episode. Today, I'm joined by another esteemed guest, Mr. John A. Paulson. A little background info about Mr. Paulson. He launched and led Paulson & Co., a New York-based investment firm in 1994. Then in 2020, decided to turn his hedge fund into a family office. He's been called by many as one of the greatest hedge fund managers of all time and a man who made one of the biggest fortunes in Wall Street history. He is widely known as the man who executed the greatest trade of all time. His bet against the U.S. subprime mortgage lending market netted him $20 billion in profits for his clients, himself, and employees in 2007. Mr. Paulson is now a philanthropist, donating millions to educational institutions like NYU, Harvard, and New York City charter schools with a focus on improving education at all grade levels. In 2015, Mr. Paulson donated $400 million to Harvard University School of Engineering and Applied Sciences, which was the largest gift received in the university's history. Today, Mr. Paulson and I will be talking about his big short during the 2008 financial crisis, the fundamentals of hedge funds, and his career in philanthropy. So without further ado, Mr. Paulson, welcome and thank you for joining the podcast.
Thank you, Logan. It's a pleasure to be on your podcast.
Of course. And now, before we jump into today's topics, I would love to hear your story and how you got into finance, the hedge fund industry, and how did that eventually lead to the founding of Paulson & Co.?
Yeah, thank you, Logan. It all started when I was a student in the business school at NYU, and I took a course called the Distinguished Adjunct Professor Seminar in Investment Banking, and it was led by the chairman of Goldman Sachs at the time, Gustav Levy, and he brought in the heads of each of the key divisions of Goldman Sachs, which at the time were capital markets, M&A, and risk arbitrage. And the head of risk arbitrage, which at the time was Bob Rubin, who was Gustav Levy's protege and ultimately became chairman of Goldman Sachs and Treasury Secretary as well. And he led the risk arbitrage department. And I think he was in his 30s at the time, was already the most profitable partner at Goldman, running the most profitable division of Goldman, which was investing the partner capital in proprietary trading strategy of risk arbitrage. So, at the time, I was enamored with that story and decided, I wanted to, work in risk arbitrage. And what they told me at the time, the way to do that was to go to Harvard, get your MBA, then work at in mergers and acquisitions. And if you were successful, then you could work in risk arbitrage. So that's exactly what I did. I went to Harvard Business School. I got my MBA. I joined Bear Stearns in the M&A department, ultimately became a partner in mergers and acquisitions, and then left Bear Stearns and joined a private risk arbitrage firm called Bruce Partners, which had it's a very private company, but had a stellar track record in risk arbitrage. And although private at the time I joined them, was one of the top 10 largest Wall Street firms ranked by capital, although they only managed their family's money. And after 4 years at Bruce, I left and formed Paulson & Co., focusing on risk arbitrage investments in 1994.
That's great. And now I want to move on to the first topic of our discussion. I'd like to ask some questions about what hedge funds are, the industry, and your investing philosophy over the years for our listeners. So my first question is, how would you define a hedge fund? And can you explain the difference between a hedge fund and a traditional mutual fund and the pros and cons of each?
Yes, hedge funds, the unique aspect of a hedge fund is they can go long a security as well as short a security, while long only mutual funds generally only go long. So by adding a short capability to your investing repertoire, you can profit when markets go up, and depending on how you're positioned, profit when markets go down. And by doing that, you can reduce the volatility of the fund, earn non-correlated returns, and depending how well you execute, potentially offer higher returns than traditional long-only investing. So I would say the the goal of hedge fund investing is to offer above average returns with below average volatility, and you can do that by managing a long short portfolio. The other aspect of hedge funds, from a financial business perspective, it's a very simple business. You earn a 1% management fee and then an incentive fee, which is typically 20% of the gains. And that's generally fair, is that the investor who puts up the money gets 80%, and then the manager for managing the money gets 20%. So there's an alignment of interest. But the numbers add up pretty quickly. So let's say you were managing 10 million in capital. 1% of 10 million would be 100,000. So you get 100,000 management fee. And let's say you did 20% of gross returns on the 10 million you were managing, that would be $2 million gain. So 20% of that would go to the manager, 20% of 2 million, 400,000 go to the manager. So you add that to the 100,000 management fee, you can earn roughly 500,000 in fees managing 10 million if you can earn a 20% gross return. Now, multiply that by 10. Instead of managing 10 million, you're managing 100 million. You can earn 5 million in fees. And multiply that by 10. If you're managing $1 billion, you could earn 50 million in fees. So the numbers progress pretty wildly. If you manage 10 billion and earn 20%, you can make 10 times 50 or 500 million in fees. So it can be a very, very lucrative business, just following this model, if you can produce above average returns and manage a lot of capital. At our peak, we managed about 35 billion, and our returns were even higher than 20%. So, the fees produced to a hedge fund manager can be very lucrative, and that's the attraction of being in the business. I'll say one other thing: there are very minimal capital requirements to launch a hedge fund. You basically need, a place to work, and that's about it. There's no capital investment, but obviously you need the ability to manage money in a attractive way to investors and have some unique capability that causes investors to want to entrust you with their capital and allow you to manage it for them.
So, could you ultimately say that the main similarity between the two is they both invest in a diversified portfolio and they want to achieve something called alpha, but one takes on more risky investments than the other?
I don't think hedge funds are more risky because you can go short and profit when the market goes down. Hedge funds, conceptually should be less risky. So in our investing history, we were less risky than a long-only manager. We had lower volatility, lower drawdowns, and higher returns. So, for instance, in the financial crisis, when the market fell 35% in 2007, we were up in 2007. So, generally, because we're able to profit when markets go down, produce above average returns, have lower drawdowns and less volatility, becomes kind of like a have your cake and eat it too. And if you know what you're doing and have a knowledgeable in a particular sector, those are the ultimate goals of managing a hedge fund.
Got it. Okay. And obviously, when we hear the word hedge fund, we obviously know what a fund is. That's, assets, that's securities being managed. But when we hear the word hedge or hedging, we often get confused. So could you explain what does hedging in a hedge fund mean? And yeah, could you explain that?
Yeah, hedging means that you want, instead of long only, if you're long only and the market goes down, you're going to go down with the market. But if you want to hedge your investment, short something against the long, then if the market goes down, you'll lose on your long position, but you'll make money on the hedge, the short position. So by having a hedge against your longs, you reduce the volatility by profiting on the short side, and you can use those profits to hedge losses on the long side. And depending how you're positioned, you could, in many cases, profit even though the market goes down, depending on the type of shorts you have and the net exposure of your fund.
So could that be the same way if your long position goes well, then it can cover your short position as well?
That's a good point. If you're short and the market goes up, you lose money. So that's why many people don't like shorting stocks because they want to make money when the market goes up, and if you're short a stock, you lose money when the market goes up. So that's where the expertise of the manager is, in constructing a portfolio that has both longs and shorts. And ideally, you're picking out investments, uh, you know, uh, that will go up when the market goes up, and the shorts may go down even if the market goes down. So that's where the expertise in managing a long short portfolio comes in.
Yeah, no, I was getting this idea kind of from earlier this year in the GameStop short squeeze. So I was getting that idea. I
Mhm.
was like, yeah. So I want to dive deeper more into kind of like the investment strategies that hedge funds use. So could you go into more depth and talk about what kind of investment strategies do hedge funds typically use?
Yeah, well, I'll talk. I'll take the biggest category is long short, and you'd go long. You generally concentrate on an area. Let's say you concentrate on automotive industry, and you believe certain auto companies will go up and certain auto companies will go down. So in that situation, if you think Tesla is going to go up, you go long Tesla. You think GM is going to go down, you go short GM. And if you're really knowledgeable and about your 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 the companies you're investing in, it's possible that Tesla could go up and GM could go down, and you can profit both ways. Or if the market goes up, Tesla will go up more than a GM, and you'll profit when the market goes up. And if the market goes down, GM will go down more than Tesla goes down, and you'll either lose less or potentially profit when the market goes down. So that is the largest segment of hedge fund investing. We went not to long short. We specialized in another area called risk arbitrage, which is, or also known as event arbitrage, which is betting on the outcome or investing based on the outcome of an event rather than whether or not the market will go up or down. And I'll give you an example. In a takeover situation, let's say a company A is buying company B for $50 a share. And prior to the announcement of the merger, company B was trading for $30 a share. So when the deal was announced, the company went from 30 to, let's say, 47, and there was $3 left on the table. When the merger would close, the stock would move from 47 to 50. So in risk arbitrage, we would buy the stock at 47, and then when the merger closed, we'd get 50, so we'd make $3. Now, $3 doesn't sound like a lot of money, but you take $3 over 47, it's roughly a 6% gross return. And if the merger takes 4 months to close, you can multiply it by 3, you'd make an 18% rate of return. Now, $3 is not a lot, but 18% annualized is a pretty high return. The market on average over its history is probably compounded somewhere around 9%. So while certain stocks go up a lot, they go down, and over time, it's somewhere around there. Now, if you can make 18%, now the beauty of risk arbitrage is, let's say you buy the stock at 47, and while you're waiting for the merger to close, the market falls 20%. Well, as long as this deal closes at 50, you'll make the $3, regardless of whether the market goes up or down. So that's why it's uncorrelated. So what we would do is have a diversified portfolio of many different merger situations, because occasionally they won't work out and the stock will fall. But over time, if you are an expert in judging the risk of mergers, you can construct a portfolio that the returns will be completely uncorrelated with the market and potentially earn higher rates of return than the market on average with lower risk. So that's that became our specialty, investing in risk arbitrage, primarily companies undergoing mergers.
Now, can you correct me if I'm wrong, but in risk arbitrage, the acquiring company, the one that would be acquiring the company, their stock price would most likely go down. So then you would put options on them, and then the target company, most likely their stock would go up. So you would go long on that.
Yeah, it's a good question, Logan. It depends if it's a cash deal or a stock deal. So if it's a cash deal, it doesn't matter if the acquirer stock goes up or down. They're agreeing to pay a fixed amount of cash for the target. So all you do is buy the target at a discount to the cash offer. And as long as the deal closes on the agreed terms, you earn whatever the spread is. In a stock deal where the acquirer is offering stock for the target, then it is very volatile because if the acquirer stock goes down, you're going to get less in value for your stock as the target. So what you do in that case is if, let's say, company A is offering one share for company B, you go long company B, the target, and you'd short one share of the acquirer, company A. And the spread is similar to a cash deal, but by shorting the acquirer stock and going long the target stock, you lock in the spread. So if you set it up at, let's say, $2, it doesn't make a difference. Once you set up the spread, if the acquirer stock goes up $10, then the target stock goes up $10. The spread remains $2. If the acquirer stock goes down $10, the target stock goes down to the spread stays $2. So by shorting the acquirer stock and going long the target stock in the same ratio as being given in the merger, you lock in a spread, and then you're indifferent to whatever happens to the market. All you care about is that the deal closed on the original terms.
Great. Now, I'd like to now transition into your famous Big Short during the housing market crash and your other shorts against UK banks during the 2008 financial crisis. So, before we dive deeper into your Big Short in the process, I read you use credit default swaps to short the mortgage-backed securities that banks issued during the time of 2006 to 2008. Can you explain what a mortgage-backed security is and what a credit default swap is?
Yeah, sure. Just a mortgage backed. What they did was when people buy a mortgage, you get a mortgage to buy a home. The investment banks would buy, let's say, $1 billion worth of mortgages and then put them into a security and sell those securities to the public. So it was a way of securitizing mortgages and turning them into public securities. When they turned them into public securities, though, they somewhat complicated it by offering tranches. So generally, there were 16 or 17 different tranches of the mortgage-backed security, which the top layers were called AAA. They could have 6 different layers of AAA, the most senior. And then you had AA, A, triple B, double B, B, and then you had the equity tranche. And the way the waterfall worked is if there was a loss in the pool, the lowest tranche would take the loss first. So if you owned the AAA security and there was a 20% loss in the pool, you still got paid 100% of your money back. However, if you own the triple B security and there was a loss in the pool, that the attachment point in the triple B was generally around 6%. So anything below 6%, the triple B got par. It was only about 1% thick. So any loss above 7%, the triple B would be wiped out. Based on that structure, they sold these mortgage-backed securities. So let me just ask if there's another question after that. That's the structure of a mortgage-backed security. Now, generally, home mortgages were the safest investment outside of U.S. Treasuries. So the mortgage-backed security market zoomed in value. And, at some point, at the point in '07 was actually larger than the US Treasury market. It was about a $10 trillion market with about, 1 trillion in a subprime mortgage securities and the rest in either Alt-A or traditional mortgage-backed securities.
Oh, could you also explain what a credit default swap is?
Yeah, so a credit default swap is just a synthetic version of a mortgage-backed security. So instead of buying the actual security, you can buy a credit default swap on that security. And what would happen, if the security doesn't default, you pay what would be the interest on that security. But if the security defaults, then the holder of that security would have to pay you a par for the loss on the security. So if you thought a security was going to default, you'd buy protection on that security, and you'd pay the interest rate to the seller. And if the security didn't default, you'd just be paying that interest rate. And then once the security matured, you just basically take a loss. It's like shorting a bond. If the bond doesn't default, you just pay the coupon. However, if the mortgage defaults, then the seller has to pay you a par to pay you for the default of the security. So it's a synthetic form of buying a mortgage security. It's also can be viewed as a form of insurance against default.
Now, do you think a good example in a more simplified manner for a credit default swap, could you say a credit default swap is like insurance on a house if it were to burn down? For example, the credit default swap would be the insurance. The mortgage-backed security would be the house. Default on a
Yeah,
bond would be represented by the fire, and then a CDS
exactly.
seller would be the insurance company.
Exactly. That's a good way to look at it.
Got it. And then for a mortgage-backed security, did investors get principal payments and interest payments, or did they only get principal?
Well, it depends if you're on the long or short side. If you're on the long side, then you would get the interest um, on the security, not the principal. If you're on the short side, you'd pay the interest, and only in the event of a default would a buyer of that security have to pay you the principal back.
Great. We've been talking a lot about shorting, and for those who are not familiar with your short against the housing market, could you explain what it means to short a position?
Yeah, I wouldn't say I shorted the housing market. I shorted individual mortgage-backed securities. So what if you go long a security, you profit if the security goes up. If you short a security, you profit if the security goes down. So that's the most simplified way to look at a short. A short is the opposite of a long. So you lose if the security goes up, but you make money if the security goes down. The actual mechanics of shorting are, there's all sorts of ways, different ways to short, but uh, uh, the economics of a short are that simple. You just lose if it goes up, you make money if it goes down. So when we shorted mortgage-backed securities, we set ourselves up to profit if those particular securities went down.
And when you mean down, you mean like the underlying value of the bonds. So if it was worth something like $1,000 and it go down to $900, just hypothetically, they didn't
Yeah,
make a
yeah. I
profit.
think an example is, let's say someone buys a house for $100,000 and they get a mortgage for 90,000 to buy the house, and then the owner of the house defaults. He can't pay the mortgage anymore, and then the mortgage holder forecloses on the house and gets the house in return for the mortgage. And then when they go sell the house, they only get 60,000 for the house. So the mortgage security that was 90 only gets 60 back. So there's a $30 loss on the mortgage. And that if you owned 100% of the mortgage, then you'd lose 30 of the 90. But because these securities were tranched from AAA to, let's say, single B, it's only the lower tranches that would lose 100% of their investment, while the higher tranches would still get par. So what we did was we shorted the lower tranches, the triple B tranches of these mortgage-backed securities. And you basically only needed a loss of 7% on the whole pool before the entire triple B was extinguished. So those are the tranches of the mortgage securities that we focused on.
And you actually shorted junior tranches that were made of subprime mortgages. Is that correct?
Yeah, so the mortgage-backed, I mentioned the mortgage-backed securities market is a very large market, and you have, the most higher quality mortgages, which are made to, high credit-worthy borrowers. That's the biggest segment of the market. And then you have what's called Alt-A, which are kind of mid-level credits. And then you had the subprime mortgages, which were the mortgages made to the riskiest credit borrowers. So since we were betting on the short side, we wanted to short the riskiest securities, which had the highest chance of defaulting. And generally, this market was characterized by very poor underwriting, very low credit standards on the part of the borrowers. That's why they're subprime, below prime. And there was also a lot of fraud in the valuation of the houses against what the mortgages were based.
Got it. And now, could you walk me through the process of how you purchased these credit default swaps? And in general, how are you able to place your bet against the subprime mortgage-backed securities?
Yeah, the amazing thing is that the history of as I said, of mortgage performance was very, very high. So according to Moody's and S&P, there had never been a default of an investment grade mortgage-backed security, and never being, I guess, post World War II or post 1950. And we said, oh, well, they did default in the Great Depression. They said, well, unless you think we're going to have a Great Depression, we don't think mortgage securities are going to default. And they'd laugh. But then they also said, we go back 40, 50 years, but we don't go back further than that. That's, they had enough data, 50 years. And the truth of the matter was there hadn't been a default of an investment grade security. The problem is that the quality of the securities continued to deteriorate. So while there'd never been a default of an investment grade security, there'd never been such low quality securities issued in the past. So we didn't think the past was necessarily representative of the future. And in fact, the quality of the underwriting mortgages just got worse and worse. It got to a point where in the subprime land, the lenders would say, no credit, no money, no cash, no problem. 110% financing from, one of the company, Ditech Mortgage Finance. So they would literally, if you were a borrower, you had no credit, you had a horrible credit rating, you had a history of never paying your money back, and you had no cash to put down to buy the house, they would still lend you 100, in this case, 110% of the purchase price of the house. So you can actually buy the house with no money down and get 10% of the purchase price in your pocket. As crazy as that may sound, even though you had the worst possible credit rating. So the standards, the underwriting standards just plummeted. The only thing that kept these mortgages performing was that the housing market was rising so rapidly. So even if you couldn't pay your mortgage, if you defaulted, the lender would take back the house, but the house went up in value. So they'd sell the house for more than the mortgage, and they'd sustain no loss. Or alternatively, if you couldn't pay your mortgage, they'd refinance you with a new mortgage. You pay off the old mortgage. So this pattern continued as long as home prices were going up, and you can bail out bad borrowers either by selling the house at a higher price than it was purchased at, or by refinancing the mortgage with a higher mortgage than the one you originally bought. So this sort of game, was poised to stop once house prices started to decline. So when we got involved, the house prices weren't declining, but the rate of growth was slowing and trending straight downward. So I think in 04, prices may have risen 12-15%, but starting in 05 or early 06, each month the rate of increase started to decline in a very predictable pattern. So it went from 13% to 12 to 10 to 9, 8, 7, 6. And there was some point it was trending that the not only would the rate of growth slow, but that they would go into negative territory. The other, in addition to home prices falling, the credit quality was deteriorating and the delinquencies were rising. So the percent of subprime borrowers that were 90 days delinquent, started going from like 5% to 6% to 7%, corresponding with the decline in home prices. It got to some point that over 20% of the subprime borrowers were 90 days delinquent on their mortgages. At the same time, the year-over-year change in home prices was falling to low single digits. So it looked like once the home prices stopped rising and the delinquencies kept rising, that at some point there would be mass defaults, that the homeowners would not be able to repay the mortgages. The home prices, if they were sold, would not cover the par value of the mortgage, and that the availability of mortgage financing would decline, so that people could not refinance their way out of the mortgage, and ultimately the mortgage market would collapse. So
And
we saw these trends occurring, and just a continuation of those trends, which you could time based on the speed they were occurring, you could sort of, or at least we were able to predict very precisely when we thought the market would collapse.
where did you buy your credit default swaps? Did you buy them from banks?
Yeah, we only bought them from banks, so we never bought them from end users. So we traded with all the banks from Goldman Sachs, Citibank, Morgan Stanley, Credit Suisse, Deutsche Bank. They were very sophisticated, knowledgeable market makers. So we bought, hundreds of millions, billions from each of the banks. And I think at the peak we were short about 25 billion of mortgage-backed securities through credit default swaps, with all the major banks being our counterparties. And again, we only shorted the triple B tranche, which meant that a loss of 7%, these securities would be extinguished. And the triple B tranche was the lowest investment graded tranche. So that's why there was so much confidence in buying these securities, because there had, until this time, never been a default of an investment grade security. But we predicted the losses on these pools would be in the 20%. So these things were toast, in our opinion. And the amazing thing is we could buy the protection for only about, on average, 1.5%. So we'd pay 1.5% a year. And if we were wrong and they didn't default, we'd be out 1.5%. But if they defaulted, we would earn 100 cents. We actually got the cost down through various means to about 1%. So in essence, we risked 1% in order to make 100% if they defaulted within the average timeline of these CDS, which were about 2 years. So it was a very skewed trade where you lost little if the trade didn't work, but you made a lot if it did work.
Did you ever think of shorting the senior tranches? Mostly because I'm thinking of the Big Short, and I'm thinking how banks they put subprime mortgages into these higher tranches, these senior tranches that were actually graded, AAA, double A, but in reality they were made of bad mortgages. So did you ever think of doing that?
Yeah, Logan, it gets even more complicated in the financial machinations they created. So there's the actual mortgage-backed security, uh, which has AAA tranches and double B tranches. But there, in order to get a default on the AAA tranches, you needed a loss. They had attachment points of like 70%. So you needed a 30% loss before you would impair the lower AAA tranches, but you would never be able to impair the higher AAA tranches. However, what's confusing is that they created these new structures called CDOs, which were they would buy 100 triple B tranches from 100 different mortgage-backed securities, and then say, oh, because we're diversified, the risk of loss is lower. And they form these CDOs of 100 different tranches of triple Bs. And then they sold the securities in the CDOs like 60% for AAA and down. So in those situations, the you thought you were buying AAA securities, but the underlying collateral was only triple B. And if while each of the securities were different, they were all very, very similar. So if the triple Bs were all wiped out, let's say you had a loss of 12% would wipe out, on average, would wipe out all the triple Bs. And in that case, the entire CDO, the triple A's would go to zero. So there was a triple A's of CDOs and triple A's of mortgage-backed securities. So very, very few, if any, AAAs in the mortgage-backed securities defaulted, but almost all the AAAs in the CDOs of triple B tranches or more, they did default. So we did short. I mean, the highest return came from shorting the AAA tranches of CDOs that were collateralized by triple Bs. And in those situations, we paid like as low as 16 basis points. And I remember buying size. The last ones we did were 35 basis points, still nothing. We paid a third of a cent per year. And when these defaulted, they went to zero. So on those, we made like 300 to 1 returns. That's when I said we got the average cost down from 1.5 to like 1%, is by doing a mix of mortgage-backed securities and CDOs. But yeah, the triple A tranches of CDOs collapsed, and that was, one of the public deals we got involved in is that Goldman Sachs structured a CDO called Abacus, and that was about $1.6 billion CDO of just triple B tranches of underlying securities, and we sold $1 billion worth of the AAA to Goldman, and Goldman resold it to someone else. And this happened very, very fast. When the dust cleared, the AAAs went to zero in less than a year, probably about 9 months. And the buyer sued Goldman, and ultimately the SEC stepped in and said Goldman did not fully disclose the securities. Anyway, they settled this, but Goldman was the intermediary. We were the owner of protection. But in that situation, yeah, it was a AAA defaulted less than 9 months after securitization. The buyer lost 100% and we made 100%. So it was pretty whacked out situation of what was going on in financial engineering at that time.
but it definitely worked in your favor. So, back then, did banks have to make you credit default swaps specific to mortgages, or were mortgage swaps already in use before your bet? I'm getting this idea from the Big Short movie, where I believe Deutsche Bank had to create the CDS contracts. So I was just curious if that was the same situation for you.
Yeah, you're very smart, and these are, sort of minutia, but the mortgage-backed securities were created independently of ourselves. So the banks would buy the mortgages, roll them up into a securities, get them rating, and sell them to investors. But the CDOs of the triple B tranches of mortgage-backed securities, those were synthetic. So you would have to find both a buyer and a seller in order to create the CDO. So in that case, when Deutsche Bank as well as Goldman was looking to structure a CDO, they had to find a seller of protection. So we sold these securities to the CDO, then they structured the CDO, and then they resold the tranches from that CDO to investors. So those were more bespoke in nature, and that you needed to match the buyers and sellers of protection in order to create the CDOs.
Now, I am curious, what was the risk and return trade-off when you placed the trade? What happens if the bet did fail? What would the bank get from you?
Yeah, the bank just got on average, 1% interest. So I think we scaled this up in that, we were spending about 2%, yeah, 2% in our funds. We were willing to lose 2% a year. So that means we were managing, I believe, 6 billion at the time. So 2% was 120 million. And that allowed us to short uh, uh, roughly 12 billion of securities. So, and that cost us 120 million a year. And that was equal to 2% of our capital. So if the trade didn't work, we were making like 12% a year. So instead of making 12%, we would have made 10%. We would never, that's all we risked. But yet, if the securities defaulted, if all of them defaulted, we would have made 12 billion or 200% in our capital. So it was a very, very skewed trade where you lost, a very small amount if it didn't work, but you made a fortune if it worked. So it was very asymmetrical. But for us, it wasn't a crapshoot. We understood the trends of the mortgage market so well that we thought we could almost predict with a degree of precision when the market would default, and that we thought it was a very high probability that the securities we would short would default. So we shorted about 12 billion in our main funds, but then we wanted to get more aggressive, so we set up specific credit funds where we took even more concentrated bets. We shorted basically $12 of securities for each dollar of investment. So we raised $1 billion roughly in these credit funds, and we shorted 12 billion, ultimately 15 billion of securities. And in total, we had about 25 or 26 billion of shorts, 12 billion in our main funds and 14 in the credit funds. And ultimately, all these securities defaulted as we anticipated. And, depending on we covered, we made returns of probably 50 to 100% in our main funds, and then returns of over 1,000% in our credit funds.
So to reiterate, if the bet went well for you, right? If the mortgage-backed securities defaulted, then you would get the face value of all bonds that you bet against. For example, if you paid, let's say, $1 million in premiums for $100 million in protection on multiple mortgage bonds, then you'd make 100 million. And
You
then,
get,
but if your
go
bet
ahead.
didn't go well, then you would be losing money based on the amount of premiums you paid.
Which is 1 million. Exactly. That's exactly right. If the bonds didn't default, I paid 1 million. If they defaulted, I made 100 million. And that's exactly what happened.
Got it. So I think that's
That's
where
why
the
it's
I
called the greatest trade ever. It's the
there you
most
go.
asymmetrical trade where you can lose very little, but you can make a fortune. And it rarely ever happens that investment grade bond default
Oh yeah.
happens. That's why the returns were so skewed. But we got both the security and the timing right, and we're able essentially to make that 100-to-1 return.
And now, obviously, hedge funds are often known for using leverage to help maximize the returns. So I think another important question to answer to the story is how much of your assets under management did you use to place your big short? And did you use any leverage to boost your trade?
I think the investment, these essentially we bought options. The credit default swaps are like options. So you spend 1% to make 100%. So we managed 6 billion. So we didn't borrow any money. We just spent about 120 million in annual option premium, which was about 2% of the assets we had under management in our main funds. In the credit funds, we spent about 8% of our capital in option premium. Oh no, actually 12% per year for a 2-year time frame. So if we managed $1 billion, we were spending 120 million on option premium. So if none of the bonds defaulted over a 2-year period with our fees, we would have been down about 25%. So that's what we risked. So we told investors, invest in the credit. If you invest in the base funds, we're only spending 2%. If we make 10% in our other investments, you won't lose money. You just make slightly less than you would if we didn't have these credit default swaps. But in our credit fund, we didn't have anything else besides the shorts. So we'd said over a 2-year period, you could lose 25%. But if the investment works, you can make over 1,000%. So for those that were a little more risk averse, they went to the credit funds. And obviously those turned out very well.
Got it. Now, in retrospect, your housing market short was a bold and risky bet. So I think the big question is how did you see the collapse of the housing market before everybody else? And why did you decide to go through with the trade, considering the housing market was super stable during '05 and '06?
Yeah, I think that's a good question. I sort of answered it before. You had a massive deterioration in credit quality. I gave you examples how ludicrous the underwriting terms were for credit, that people with no credit or a history of bad credit, no jobs, no income, could still borrow 100% or more of the purchase price of the house. So the credit, the delinquencies were already soaring in these loans. So they were every month rate of these mortgages that weren't being paid was rising, and home prices were falling. So it was kind of a very simple physics problem. If home prices kept falling and went negative and delinquencies kept rising, at some point the mortgage market would collapse, and then these mortgages would sustain losses. So it just what we couldn't understand, it became very obvious to us, but the problem is the machinery, the factories that were just geared up to buying mortgages, securitizing them, selling them, they just were oblivious to what was going on, and they couldn't stop the machine. So even though the underlying fundamentals were deteriorating, the market pricing didn't adjust. So it was an incredible opportunity to buy protection at very low cost when it seemed obvious to us that these securities would default.
Great. And now I read in an article by Business Insider that you had additional bets that people may not know of that helped you gain another 5 billion during the '08 crisis by shorting stock prices of financial firms from the UK. Could you elaborate more on why you shorted Lloyd's Bank and the Royal Bank of Scotland? And did you see fraudulent behavior from both companies?
Uh, well, by the way, you're right in that we did short banks, but it was not limited to the UK. We also shorted banks in the US.
I think it was New
Uh,
Century.
we shorted New Century. We shorted Fannie Mae, Freddie Mac, Citibank, Washington Mutual, IndyMac, um, Bear Stearns, Lehman Brothers. Basically, all these banks were highly levered, meaning on average, for each $100 of assets, they only had 3% equity. So just simply, if the assets fell from 100 to 97, their equity would be wiped out. So we started focusing on the institutions that had large quantities of subprime or poorly performing mortgages. And the biggest mortgage lenders were the banks that we were shorting. So Fannie and Freddie were 100% mortgages, and they were even more levered. They had only 1% equity, if you can believe it. So they had a 1% loss in the portfolio would wipe out the equity. And then Lehman Brothers and Bear Stearns, they were the two largest mortgage lenders in the country. And they had both had about 3% equity, and about 20 to 30% of their portfolio, of their total assets, in lower quality mortgages or otherwise high risk securities. So if they had 30%, for instance, in risky credit instruments, they took a 10% loss. That would be 3%. That would wipe out the equity. So what we did is we looked at the banks with the most leverage and the riskiest portfolios, and then we estimated. It was a pretty simple analysis, because when the mortgage securities started to fall, some of them were trading at 60, 70 cents on the dollar. The banks didn't fall. So all we did was take the market value of the securities they had in their portfolio and then estimated what their losses would be on their portfolio, compared that loss to the amount of equity, and then ranked them based on the loss to equity ratio. And we picked these stocks where the losses, by the way, the losses only had to be 3% in order for the loss to equity ratio to be 100%. So we ranked them, and based on that ratio, and Fannie and Freddie had the highest ratio. I think it was over 200%. And then any bank that had over 100%, we shorted, and we were 100% right. Fannie and Freddie both failed, were taken over by the government. Lehman failed. Bear Stearns was taken over by JP Morgan. Washington Mutual failed. New Century failed. IndyMac failed. And some of the other banks, while they didn't fail, the equities, like Citibank, fell from $50 to $2 a share, and then they were rescued by the government. So that simple analysis, allowed us to pick the worst securities and to short those, and those provided additional gains.
Great. Now, Mr. Paulson, we are going to move on to what I believe is the most important subject of today's discussion. While everyone in the finance world knows you for your investing career in Big Short, some might not know you also have another side of you that you take pride in, which is your philanthropy career. I'd like to dive deeper into your philanthropic efforts. So, could you talk about how did you first get into philanthropy and what drives your desire to give back to society?
Well, I think, generally as Americans, we are philanthropic people. So, we care about, the well-being of our other citizens. So I grew up in a family that, we weren't wealthy, but we always contributed to causes, whether it was UNICEF or, Channel 13 or feeding hungry children abroad. Even at Halloween, when I was a child, we used to trick or treat for UNICEF rather than for candy. And, my mother organized that. She said, oh, this is what are you going to do with all the candy? That's a good way to raise money for poor children. So we always had that, philanthropic bent. And when I graduated from school, I was grateful for the education I had at both NYU and Harvard. And every year, I gave to the college funds. I started out at $50 and over time moved up to probably $1,000. But I always felt, and I think it's tradition of in America that if you make money at whatever level, that you're charitable at some level, and that the wealthiest people, look at the Carnegies, the Rockefellers, they were the most charitable, and they did great things for society. So Just it was part of my upbringing that, once I became successful, was to think about philanthropy and where I wanted to give back to society. And I started with, I thought I didn't come from a wealthy background. I came from an educated background. My mother was a psychologist, and my father was a businessman. We both had graduated college, but we were like upper middle class. So I didn't go to private schools. They couldn't afford private schools. So I went to public schools, and after public schools to NYU and then Harvard. But, I always thought that the key to success was really education. And that if you had good educational opportunities, and I still believe that today, the sky's the limit to what you can achieve. So my initial focus in philanthropy was to support education, particularly those schools that were supportive to me. So Harvard, is maybe the wealthiest school in the country, but they've, given opportunities to so many people. So many successful alumni of Harvard came from very modest means, received scholarship at Harvard, and became leaders in their field. And I'm one example of that, but there's countless others. So uh, you know, uh, probably, the colleges in general have done so much to create equality and movement amongst economic classes than really anything else. So uh, my largest gift was to Harvard, and Harvard is strong in all areas, but the one area they were, weren't particularly strong in was when engineering, and Stanford was very strong in that category, and Harvard had really focused on hadn't focused on applied sciences and applied engineering. So that was where they wanted to focus. So we gave it a gift to endow their school of engineering and applied science. And I think that'll have a material impact on Harvard's position in technology going forward. It already has in computer science and medical technology and data sciences and the like. And then, we also gave money on the other end to charter schools because, we are very concerned with inequality and lack of economic opportunities for minorities. But we found that the charter schools in New York City, in particular Success Academy, that they were 94% of the students were underrepresented minorities, and yet their charter schools ranked among the top 1% of all public schools in New York State. And the outcomes were so much stronger than the traditional schools that I felt the best way to provide economic opportunities for minority was to support the best education alternatives for minority children. And that's why we became major benefactors and still are for Success Academy charter schools. So that was our initial focus in investing in education opportunities. And, we continue to do that. The other area I wanted to focus on was cultural activities because, I believe in the arts and other forms of culture aren't as well supported as the sciences, but yet it's so important to society and our mental well-being. So in the heart of New York is Central Park, and that is really a refuge for so many people. So coming from New York, I wanted to do something positive for New York, and it's nothing more beloved than Central Park. But I think most people don't realize that that's funded by a private conservancy called the Central Park Conservancy. So that Central Park also became a major beneficiary of our financial philanthropy, and that's probably the gift that it's given people the most pleasure because everyone, both foreigners and local, use Central Park, and it's a real refuge for people that live in New York City.
That's great. And, I know a while back you started something called the Paulson Foundation. Could you elaborate more on what do you and your wife, Jenny, hope to accomplish through your philanthropic efforts at the Paulson Foundation?
Well, that's right. I think we transferred, close to half our wealth to the foundation, and the foundation now has a core capital, and we're required by law to give away 5% of a year, and our focus, has been and will remain on, providing philanthropic support to educational and cultural institutions. By creating the foundation, though, and the foundation earns money, that will ideally survive, beyond my own lifetime, and this foundation will be continue to support education, cultural causes, well after I've passed away.
That's great. And the last question before we end today's conversation is, as a concluding question for our listeners, what advice would you give to young students who have an interest in a career in investing or finance?
Well, I think you need to have a passion in investing in finance. You, Logan, seem to have that passion. I had that passion as a very young child. I started trading and working and making money, saving money, investing money. I started companies when I was young as 18 and was always fascinated about, commerce. I found it fun. It's like playing a game, and it's a financial game. And if you enjoy it or passionate about it, then it's a good career to be involved in. Finance has many interesting areas. There's hedge funds, there's private equity, there's long only, there's venture capital, but it's a remarkable profession, and there's a lot of opportunities and a lot of ways to create personal wealth. So if you're passionate about it, then what you would want to do is study, major in business either at the undergraduate or graduate level, and then pursue a career in finance, whether it's investment banking or one of the investing areas that I just outlined. And if you do that and succeed, there's just enormous, opportunities to achieve success.
So, do you think success is really the root cause of success is passion and loving what you do?
Yeah, thank you for bringing that up. I do. I think it's hard to be successful doing something you don't want to do. So some people may say, "Oh, finance is a great business," but if you're not passionate about finance, you do it because someone else told you to it, but you don't really want to do it, it's unlikely you'll achieve success. So the most important thing to look at in terms of a career is what do you really love to do? And maybe you want to make movies, or maybe you're an artist, or maybe you want to work in helping people, or maybe you like medicine or science or physics or math. So it's you don't. I think the right thing is not to ask other people what you should do, but ask yourself, what would I be doing if I wasn't working? What do I like to do in my spare time? Because you can be successful in any area. So it's best the most important person to ask is yourself. What do I love doing? What would I do if I wasn't working? What am I passionate about? And that's the area that you should pursue a career. And when you're passionate about it, the learning just comes so much faster, and you're likely to be very successful in that endeavor.
Awesome. Mr. Paulson, thank you so much for your time and sharing your wisdom and advice with the next generation of investors. I'm sure our audience learned a lot in the fascinating world of hedge funds and philanthropy. Your legacy will live on forever and be appreciated by many in the near future. It was a pleasure hearing your adventure.
Well, thank you, Logan. Thank you for organizing this podcast. You're really doing a great job, and it's a pleasure for me to participate in it.
Thank you.
Take care.